Hello and welcome to the Providence Investment Update for July 2025. My name is Michael Ogg and I'm joined here by Marc Wait, Chief Investment Officer at Providence. Welcome, Mark.
Thanks, Mike.
Mark, I thought I'd start off with markets over the last 12 months. There's been a lot of noise in politics, markets, etc. Could you give us a recap of the last 12 months and how Providence portfolios have performed?
Absolutely. So it's been a very positive year if you look at sort of performance of markets from point to point. So if we sort of look at equity markets, most equity markets have had double-digit returns. And indeed, if you look at sort of global equity markets, including some currency, it's been close to 20%. If you look at the fixed income markets, they've generally outperformed cash. So they've had a pretty positive return over that period of time. Credit has done quite well over that period. Infrastructure has also done pretty well in terms of double-digit returns. We've started to see some recovery in terms of the real estate markets. And then in private markets, there's probably been some areas, particularly on the equity side, private equity or venture capital, where the median managers lag some of those returns a little bit. Then when we look to Providence portfolios, it's been another good year for returns for our clients. Most of our clients have been towards those sort of low double-digit returns or high single-digit returns. And so some good outcomes, particularly relative to where inflation's been.
And Mark, moving to the global outlook and strategy, there's a lot of uncertainty, tariffs, US fiscal deficits, the health of the Chinese economy, wars in the Middle East and Ukraine. So why is the title of the global outlook and strategy Solid Foundations?
Yep.
Can you elaborate on that, please?
So we thought we'd be a little bit controversial there and really sort of reflect the fact that there's obviously some pretty good underpinnings to the global economy and markets. And that's really been reflected in that positive performance that we've just talked about. So some of those dynamics that we'd point to in terms of those solid foundations are you've seen a good moderation in inflation. And so in many economies, you've started to see central banks ease interest rates. Growth has remained reasonably well at sort of a good level. There's been some good support from fiscal policy in terms of that growth as well. You've seen good levels of profitability in US companies in the US. You've seen a very resilient banking system. So if you think about some of the volatility that's been thrown at markets, things like the sort of geopolitical events in the Middle East, if you think about sort of the hit from the tariffs, you would have normally expected that there'd be some pretty big volatility within the banking system and potentially sort of a big pickup in bankruptcies, but we haven't really seen that occur. And so it's really just a realization that there are some good underpinnings to the economy.
There seem to be some challenges facing the US exceptionalism in terms of a reason to invest. And people are talking about divesting from the US. What's your view on this?
And so I think it's a gradual sort of process. I think that's the most important thing to say. If you look at the data, there really hasn't been huge swings away from investing in the US of yet. Probably at the margin, what really happens is you've started to see a depreciation in the US dollar. So that's probably down around about 10 to 11 percentage points off the peak. So that's an important part. And then the other thing I think you'd focus on is that think about it in terms of for those countries that are saving a lot of money, so a lot of these sort of Asian exporters or Middle Eastern countries where they have sovereign wealth funds, you should probably expect that just the marginal dollar isn't flowing directly to the US to the extent that it was previously. So you probably see more money invested in other areas like Europe, like emerging markets in other parts of the world.
That's a good segue for Europe. I mean, European economies appear to be sort of coming out of hibernation after many years. Can you give me your perspective on this and how you see European markets and asset prices?
Yeah. And so we've sort of been pointing to the fact that valuations in European markets were quite low. And I think that's been for a period of time. And the backdrop's really been sort of slow growth, some competitive pressures on the companies. But then I think during the sort of first half of this year, there's been geopolitical pressure around increased investment in Europe and sort of Trump's really pushed the European economies to spend more on defense. And so Germany came up with a 500 billion euro package to spend on defense over the next period of time. And they also came up with a 500 billion investment package for infrastructure. And some of those sort of changing dynamics and some worries about the sort of the extent of valuation in the US market meant you had some pretty solid performance in some of the European equity markets. So the standout was really sort of the German DAX or the main indices, and that was up sort of 20%. And another really interesting fact is if you look at sort of European banks, they were quite lowly valued. And over the last 3 years to the end of June, they've actually outperformed the Magnificent Seven stocks, which is a sort of a little known fact, but an important one.
Yeah, right. I didn't know that either. Just moving to tariffs for a second, the market seems to be quite sort of immune to all the tariff noise since April.
Yeah.
What's your perspective on that?
So there's been a lot of moving parts. And so I think we sort of had Liberation Day, we had escalation of tariffs after Liberation Day, and then we had the 90-day pause. And recently we've been going through that process of negotiating. And of what we've seen so far in the tariffs, there's been some interesting sort of points there. I think the first thing is if you look at the US economy, predominantly, it's a services-based economy. So 80% of GDP is services. And that's a lot higher ratio than what you'd see in other countries around the world. So a lot of the pain from tariffs really comes from the manufacturing nations. The second thing is the pass-through. So if you look at the pass-through in terms of what we've seen so far in inflation, only around about 25% of those price increases from tariffs have been passed on to consumers. So they've been worn either by the US companies that are importing those goods and a little bit of pressure on their margins, or the manufacturers just cutting prices to make sure that they can continue to have demand for their product. So it's been a little bit more sanguine in that place. And then I think as well, it's just kind of there's been some really positive things in the background that sort of help markets to move forward, as we talked about before, in terms of solid foundations.
And Mark, what implications do they have on inflation? You talk about tariffs, you talk about, impact on prices.
Yeah.
How does that affect inflation?
Yeah. And I think that's the other thing that's really changed. So there was a lot of fears that there'd be a really big sort of inflationary outbreak from the increase in tariffs. And I think some of those things that we've talked about around the importance in the sort of whole of the economy is important, the extent of the pass-through is important. And then the other thing is markets are forward-looking animals. And so if you think about the way in which they're interpreting that increase in tariffs, they're looking at it more as a one-time price adjustment as opposed to a persistent move for inflation. So generally what we've seen for the US economy, the mix of growth in inflation has been that slightly more tepid growth towards sort of 1% and an uptick in inflation for 2025 towards sort of 3% as we get towards the end of the year. But then going forward, again, it's kind of a one-time price adjustment. So once you get to that higher base, forward-looking inflation is not moving forward. And that's really reflected in terms of inflation expectations in the bond market, which have remained pretty well controlled compared to where they were post-COVID.
So broadly speaking, where do you see the risks though in markets?
Yeah. So I think you've got to have a very sort of sharp eye on valuations, and that's very foundational in terms of how we look at markets. And so if we look to some of the large cap US equity markets, the valuations are quite high. So the chart that we're showing on the screen right now is of the US NASDAQ and was a really interesting period because it was a period where we had a bear market and a bull market in the same quarter. And you can see that there was a big de-rating in terms of US technology stocks as represented by the NASDAQ 100. And then there's been a big re-rating higher of them. So they're now sort of NASDAQ 100 is pushing up against sort of 30 times 1 year forward PE. And so there's some very high expectations around earnings there. And we just think you need to be really careful around that. So that's sort of one point. I think the sort of volatility that will come out of the Trump administration. I mean, we recently listened to a former Fed vice chair, Dr. Richard Clarida, and he made some interesting points. And he was saying, you've just got to be open to the fact that this is the way in which the administration negotiates. So it's unlikely that once the tariffs get bedded down, there won't be more volatility in other areas. So we should expect potentially another 3 years of volatility from the administration going forward. The other thing I think is interesting has been around sort of budget deficits and the buildup of debt. So that's definitely a risk. I do think to some extent that's starting to get priced into markets. And so you've got much steeper yield curves in the bond market and much more understanding. And I think if you look at what the US government's doing, they're really trying to attract capital in there and they're using the tariffs to increase government revenues to try and address that budget deficit.
And Mark, the flip side of the risk is where you see the opportunities.
Yeah. So we continue to think there's some good opportunities in markets. So I think the important thing is to have that sort of sharp eye on valuations. And so within equity portfolios, it's important to have a really well-diversified equity portfolio. So we continue to see opportunities in sort of global mid-caps. And that's an area where the valuations aren't nearly as testing as what you've seen in the large cap US equities. We also think that narrative that we've talked about for a while in terms of Japan and sort of changing corporate governance and unpacking value continues to sort of move forward. So activist Japanese equity investing continues to be of interest to us. We also like emerging markets. We're getting the sense more and more that in this sort of deglobalized, multipolar world, it's an interesting opportunity for some of the emerging markets to continue to sort of have some good performance following a long period of derating. And so that's an interesting space in equities. In other markets, we think what's interesting is if you look to the sort of property and infrastructure space, it feels as though in commercial property, at least in Australia, is starting to move towards the bottom of the cycle, and you're seeing some good recovery in specialist areas like retail, regional hospitality. Infrastructure is an asset class that will do well given some of those pressures on budget deficits that we've talked about before. So I think that's an interesting asset class as well. And then finally, in sort of credit, we've got that sort of barbell approach of sort of private credit, where we think with the right manager, you can continue to harvest pretty interesting yields in markets. And we barbell that with the opportunities in distressed credit.
And Mark, just finally to wrap up, I mean, given the economic backdrop, the risks and the opportunities, what are the implications for portfolio construction in the sort of short to medium term?
Yeah. So I think uncertainty means that you need to have a good degree of diversification in portfolios.
Mm-hmm.
And so that's something that we're very sort of focused on, and we feel as though that's an important thing to do. I think at the margin, as markets continue to appreciate, we'll continue to shave a little bit off our exposure to some of those sort of large cap US stocks and position money more into other parts of the world where we think valuations are more attractive and there's maybe a little bit longer runway for equity market growth over time. And then I think as well, sort of as we sort of move further into the cycle, we've got to recognise that we are moving into this sort of easing cycle for central bank policy. So potentially there's less risks in fixed income markets than there had been looking backwards. And so I think that's an important thing for us to do. But we need to have a really sort of sharp eye on valuations. We need to make sure portfolios are well constructed. It's been a mixed environment for managers. So you've got to have a really good understanding in how the managers are performing in markets. But generally, we think sort of the portfolios have done very well through a period of sort of high volatility and have really sort of weathered that environment quite well.
Thank you very much for your time, and thanks for the conversation.
Thanks, Mike. It's my pleasure to be here.
I hope you enjoyed the discussion, and we look forward to sharing our views and ideas in the next Providence update. Until then, thank you very much.